Hello and welcome to Cryptocurrency Trading Masterclass by Wealthy Education. In this video, we kick off Module 1, Profitable Crypto Trading Setups. This particular video is must-know trading terminology. Now, before we can get into trading, we have to make sure that we are speaking the same language. So, let's go through some very basic terminology. Therefore, we're able to have the conversation and talk about various strategies and ways to trade the crypto market. So the terms that I'm going to show and talk about here are not only crypto specific, but they're going to be used in any financial market. So if you decide to trade stocks or Forex later, commodities, whatever, these will all be relevant there as well. There are some very basic terms, which are pretty straightforward. So, for example, one would be the 52-week high and the 52-week low. So, it's exactly what it sounds like. So, during the year 2020, which was here to here, the 52-week low was the lowest price during that year. The 52-week high was the highest price, so it was just a little under 42,000. And the 52-week low was down here at about roughly 3,500. So that's pretty straightforward, and that, of course, is not necessarily, it doesn't necessarily have to be over the last year. It could be just over the last 52 candlesticks. In this case, though, it would still be the same. We're only a few candlesticks into 2021 as I record this. The low, the high, they're at the same spot. So basically, over the last year, the highest and lowest prices found. Pretty straightforward. There's also the bid, ask, close, and high. So the bid is what people are willing to pay for an asset. So you are bidding to buy it. And in this case, if you are bidding, you come in with a price, and I'm going to use very simple numbers. Let's just say you're bidding 5 for an asset. There's an ask, which is what they are willing to sell this asset for. And that asset might be 5.5. Well, in order for a transaction to be made, two people have to agree on a price. Sometimes they'll come back and forth to each other, so they may sell at 5.25. But more often than not, you'll hear a phrase something like hitting the bid or paying the ask. So if you are the buyer and you really want this asset, you're going to come up here and pay $5.50 for it, or 5.5 for it, and you're paying the ask. If you are the seller and you're aggressively wanting to sell, you might do what they call hit the bid. So you would sell it at 5. So the bid is just simply what you can buy it for. Ask is what you can sell it for. And here on TradingView, you can click on the watch list, and you can see there is pricing here. And notice how the prices aren't quite the same. And that's because there's a bid and an ask. And it's true with all markets. It's not just Bitcoin. It just happens to be the one that I have highlighted here. You could come to the DAX or the Nikkei or whatever. So that is always going to be the case. Sometimes you see zero spread. That's pretty rare, though. The reality is that's what makes a market. People either have to step up to buy it or step down to sell it. There is an uptrend, or what is known as a bull market, and that is clearly an uptrend. We are rising. We are going higher. That's an uptrend. There is a downtrend. So in 2018, when Bitcoin got to be so overbought and then sold off, that's a downtrend. It's also known as a bear trend. So bull is up, bear is down. There's, of course, sideways, which is really what it sounds like. It's just the market going sideways. A lot of times people refer to that as consolidation. So let me go ahead and go to a lower time frame. Let's go to a daily chart. So we've had a bull run or an uptrend, and then we just kind of go sideways. Well, sideways consolidation, it's kind of the same thing, really. It's just essentially that the market had been rallying, had been bullish, had been an uptrend, and then you spend a little bit of time consolidating your gains. Now you can go up or down, but when you go up, that's a continuation. Pretty basic stuff here, but these are things that people need to know. So, rally, consolidation, continuation. There is a couple of phrases, swing high and swing low. So let me go to the hourly chart. So a swing high means that the market swung high and then turned away from it. So that's your swing high. Just as this was a swing high back then, this is a swing low. High, low, high, swing low, start to rally. These are useful to identify trends. There's a high, there's a low, there's a higher high, there's a lower low. So that is an uptrend. Granted, it's not always going higher, but when you extrapolate this out to, say, like a daily chart, a weekly chart, it begins to look more like this. There is also a phrase known as a bounce. So a bounce typically happens after a significant sell-off. So right here, you can see that it sold off and then it bounced up a little bit. That would be the exact opposite of something called a pullback. A pullback is what it sounds like. We pull back from the trend and continue. These are healthy and they're very common. It's just the way markets move. You can't go directly from point A to point B without having some people stepping out or selling or whatever. There's a million reasons why somebody gets in and out of a market. There is the phrase go long. That means buying. Go short means you're selling. So up here at the swing high, you might want to short Bitcoin as we break down from there. Just as when you are consolidating, so we rallied and we're consolidating here. Now you're continuing on this breakout, and that's what it is called when you break out of consolidation. You might want to go long. There are two phrases known as averaging up and averaging down. These are pretty popular in the stock market. So really, as a general word of advice, you really don't want to average down. So averaging up is if you say buy it here and it continues to go, you make a short-term swing high, swing low, you break above the swing high, you decide to buy more. That's averaging up. You go higher, you buy more here for whatever reason. That's averaging up. That is adding to a position that's working. Now, unfortunately, and this probably comes more from retirement account and longer-term stock market advice, there is something known as averaging down. So let's say that you are involved in Bitcoin here and everything is going fine, and then suddenly it pulls back. You buy a little bit more here. It falls again. You think, okay, well, I'll buy a little bit more here, a little bit more here. Now, what this does, in theory at least, it's the same thing as dollar cost averaging. You'll hear financial advisors talk about that. Well, if you buy at 10 and you buy again at 5 and you buy again at 1, well, every time you buy at a lower level, it brings down the average price of all three entries from 10, in this case, 750. And then in this case, it would be somewhere near like 3-ish, maybe 4, somewhere between 3 and 4. That's because maybe you have one, for example, one Bitcoin, and of course these aren't real numbers, but if you buy one Bitcoin at $20, for example, and you buy another Bitcoin at $10, well, that's the same thing as having two Bitcoins at a base price of 15. As the markets move, for example, at $15, this would be $5 positive. This would be $5 negative, and it becomes a wash. It's your cost basis. The idea is that if you average down, then you can bring that cost basis down. Now, the problem with this is sooner or later you're going to average down and the market's going to keep going lower. So if you average there and there and there and maybe there, you think, okay, it's going to recover, and then there again and then there again, the market may not go to zero, but your account may be blown. In other words, wiped out before it recovers. So averaging down, never a good strategy. Unfortunately, a lot of people do it. It's part of human psychology. You're trying to make your position more profitable at a lower level. It can be like a retirement investment strategy. If you're going to buy like stock that you're going to hang on to for 30 years, that's a different scenario. But in crypto, that's not what you're doing. So those are some very basic terminology that you'll need to know. I encourage you to watch this video again, go through all of this, and then we will move forward in our journey together. In the next video, we're going to take a look at the best chart time frames for crypto trading.